Hello, this is Victor Santana. I'm making this short video because I'm getting a lot of questions about my strategy, and so I'm figured to help everybody else out. If I did this quick little video on how I do my trades and my setup. So here we go. We're looking at the chart here, a daily chart. Keep in mind that I'm a part-time swing trader, so it's very hard for me to trade intraday, except for maybe if I look at the 2-hour or 4-hour chart, but mostly I trade off of the daily. And here we're looking at NVDA, and without any indicators or any trend lines or anything like that, for somebody that doesn't have too much experience, it makes it hard for them to decide if where to enter, when to exit, and so on. So I've been trading all these years, and I like to keep things simple, so I want to go ahead and explain how my simple swing trade strategy works. First thing I check is the volume. So what I do here is I go and you just turn on the volume, just select the volume, and you can see the volume over here. The average volume on the last 20 days is 223 million shares daily. So to me, that's plenty enough. My minimum for swing trading is 500,000. So this easily qualifies. So that's the first thing I do to filter out the stocks, is it has to trade over 500,000 shares. This way it's not that easily pumped and dumped and manipulated. The second thing I would check then is I would put in the moving averages, and the moving averages I follow is, the first one is the 200, but that would be my first question. Is it an upsloping 200-day moving average? And in this case it is. As long as it's above the 200, then it qualifies. Sometimes it might not be upsloping as much. It might be kind of coming out of a from a downslope and starting to bend up. So as long as it's over the 200, that would start working. The next thing I would throw in is the 50-day moving average on it. And as you can see, as long as it's above the 200, and also the stock I like to, when they do the swing trade, I preferably like it to be over the 50 as well. Reason being is many of the institutionals like to accumulate more shares when it's trading above the 50. So you have a better chance to trade with the smart money, or the whales, or the big players in this case. So you want to ride on their coattail. So this is where they mostly accumulate, mostly up in this area. There are some institutions that are value buyers, and they buy below the 200, but most of the time they trade, or they accumulate over the 50. So as long as it's over the 50, in this case it is. The next thing I would check then is I would use the indicator, the RSI. I've used many kinds of indicators throughout all these years, and I use the MACD, the slow stochastic, Williams percentage, and all kinds, and I keep coming back to the RSI. So I figured, you know what, I tend to gravitate back to the RSI because it's so simple, and the way I trade, it's easy to follow. So that's why I'm a big RSI fan for it. I'm not saying it's the only way to trade, but it works for me, so I stick with it. So what I do then is, let me turn on the RSI here, and here we got the RSI, but in this case, instead of the default of being the 14-day period, I use the 5. I changed it to 5 because of the swing trades, because most of my trades last for a few days to a couple of weeks. So this helps me out a lot. I find that the signals are more reliable. So basically anything 30 reading or below is oversold, and 70 and higher is overbought. So as you can see, when it gets oversold down here below the 30, then we start getting the bounce up here, and then you got down here, we got below the 30, we got the bounce here, below the 30. We got a small little bounce. Doesn't work all the time, 100% of the time, like all indicators, but the probabilities that is greater that it will work is there. So that's what you want. You want the probabilities to be on your side. And here you got the dip below 30 here, and you eventually got the little bounce here. Okay, so that is what I used here as far as to help me figure out if we are getting ready for a reversal from a dip. The second RSI that I put on is the number 2, the 2-day period. And here it is, this basically the same. I just change it from the 14 to a 2 period. Same principle. In this case here, it turns red when it's under the 30, so you have red, and then anything over 70 turns green in the green zone. So as you can see here, it dips under 30, which is where I like to see it dipping under 30 before it starts bouncing up. And if I see this and this both under 30, I like this. The probabilities are greater that it's going to have a better bounce, especially if it's over the 50. In this case, you got that bounce right up here. Same thing, if you go back here, you have the red on the RSI 2. However, on the RSI 5, it didn't fully go all the way down 30. Now, because if the trend is kind of on the strong side, on a momentum upwards, then what I would do is I allow it to get below 50. As long as it breaks below 50, and this is also below 30, then I would consider this to add to my watch list, and then look for the bounce, which we did right here. Same thing here. You got the dip, and then you got the bounce. And then over here, you have the dip, and the dip on these two here, on this end, or even here, you got the bounce. However, in this case is here, based on my strategy, I may not trade this. Now, I use the scanning screener software. So my rules are, if it's below the 50, don't even show it to me. So this helps me avoid to keep my discipline as far as not swing trading if the stock is below, because if I see this, and in this case it's a higher high, I would say, okay, most likely it's still a good candidate. I'll swing trade it. In this case here, because we got a lower low here, even though we got a nice uptrend, if I had to guess, I would probably just let it pass and look for another stock. But it can happen. So, you know, it's got to use a little bit of discretion. It's more of a art than science. It's not 1 + 1 always equals 2. In this case here, you got 1 + 1, and you got that nice move up when you you got the answer 3 instead of 2. You got a nice move up. Anyway, now those are where my setups will start coming up. Now, to keep things simple, what I've done with the RSI 2, I went ahead and converted these lines into dots, as you would see here. And there they are. Let me stretch this out so you can see right there. So here you see you got it under the 30, you have the red dot, under 30, red dot, under 30, red dot. All right. And then from 30 to 60, it turns yellow. It stays yellow here. So these are my yellow dots. That means it's in transition. And then from 60, this is where I consider my setups, on up, then that's where the first green dot is my setup to look for. So as you can see here, just set up right there, moves up, you go back, you have the red and then green, you got your setup, moves up, red, green, you got it set up, it trades sideways and it moves up, red to green, you got to move up. All right, so that is basically how it works for me. So let me just take this off right here. And that's why you see these dots here along with the RSI 5, and that's what these mean. Also, on a strong uptrend like what we're starting to experience, what I'm going to be doing is I still wait for the red dot under 30 on the RSI 2. However, once it turns to yellow, then that's where I'm going to do the setup to look for an entry to go up in here. So red and right here, entry right here, and then go over here, red, yellow, entry the next day. You got the move up, you got red, and then it turns to green, get the entry. As long as you use the stop, which is the previous candle low, in this case it'll be right there. As you can see, it does not break it, so you stay in until you got that bump up here, and either sell part of it or not. Okay, now as far as taking profits and my where to get exit, this is pretty simple also. Say we've got the setup here. Let's say right here on this first green dot here, we're going to put a line right here all the way up to here. Make that white. Okay, this is your entry. Now stop loss, you always got to think of your stop loss. I like to just risk one candle. So in this case, this is a small candle. We're going to change this to red for the stop loss. So there's my risk right there. Now as far as where do I think, how high can it go before I take some profits? This is where the ATRs come in. So I have the ATR indicator here, and let me turn that on. Instead of bands, I also use dots. I'm pretty much of a dot person here. So if you look at 1, 2, 3, on the fourth candle, there's your setup here. So we're going to focus on these dots on the fourth candle. Each dot represents one ATR. So from this setup candle to the first white dot here, that's one ATR. To the yellow dot, that's 2 ATRs. And then the third one here, the green dot, that's my 3 ATRs. That's normally where there's a good probability it's going to reach before it considers pulling back in most cases. So I'm going to go ahead and I'm going to put that line right there. Right there. And we're going to make that one. Let's make that one here green. So here's your profit zone. I'm going to turn off the ATR so it's less confusing. So there you go. So there's your risk and reward right there. So once it reaches up, as you can see here in this example, it's already more than halfway up there. Maybe we'll get there by Monday, Tuesday, Wednesday. Get up here. If it hits, either take your profits and look for the next stock, or sell half of it and then move your stop loss to break even. Let it continue higher. If it dips and then bounces up, then you just put it up at the bottom of the swing lows, and that you kind of just trail it up if you want to ride the momentum of it. All right, so I hope that was informational or informative. That's the word I'm trying to use. Sorry. And if you have any other questions or anything, feel free and drop me a line. All right, take care. Bye bye.